Hi, everybody. This week we're going to go over some accounting methods just so you can be aware. Um, I'm certainly not an accountant. I highly doubt any of you are accountants. If you are, let me know, and I'm going to make you do this lecture. But I just want you to be knowledgeable of accounting because we're tracking our money, our organizational money uh, inflow, outflow, and we're looking at revenue and expenses. And when we talk about accounting, we're just tracking these revenues, tracking these expenses, and it gives us an idea of our organizational financial health. So taking those revenues and expenses into account, see what I did there? We would like profit, we would like organizational income, and we've got revenues. We'd like revenues to be greater than expenses. So our profit, real easy, simple, quick formula, just our revenue minus our expenses, and hopefully we're in the black. And not the red. So if you look at accounting sheets, if we're in the black, we're in a positive area. We've made profit. We've gained income. If we're in the red, then our expenses are greater than our revenues. We've got a negative number, and we are not making any profit. Now, on top of revenues and expenses and feeding into revenues and expenses, your accountant or the accounting firm, whoever you work with, whether it's in-house or it's contracted out, um, you're going to have assets and you're going to have liabilities. Assets are things that you have, you can build on, say an ambulance. We have that, and if need be, we can sell it and get some money for it. We have liabilities. This is money that we owe. Think about probably the biggest liability, most common liability that EMS organization will have will be employee expenses, salaries, benefits. That's money we owe. And then the difference between the two are going to be our net assets. So our assets minus our liabilities are going to be our net assets. And that's typically referred to as equity. So if you own a home, you know all about equity. Your home is worth some amount of money. That's your asset. Say your home is worth $200,000. That's your asset. Your liability on that home is the money that you still owe on that mortgage on that home. Let's say it's $100,000. So the difference between the two, you have $100,000 in equity, and it's the same thing with our EMS organization. So assets on the left, liabilities on the right. So we've got some cash in the bank. We've got some land, we've got some buildings. Again, if need be, we can sell and get some money for it. And equipment, total assets about $900,000 on that right hand side. Our liabilities, we owe some people some money, about $50,000. We've got other loans outstanding, so we've got about $200,000 in liabilities. So we're in pretty good shape here because our assets far outweigh our liabilities, and we've got some substantial equity here in this organization. Now, assets and liabilities tell us big picture stuff, right? We're not selling that building tomorrow. We're not getting money for that ambulance tomorrow. So day to day, we're interested in revenues and expenses, and your accountant might call these debits or credits. And those are just different labels for inflow, outflow, revenues, and expenses. So if we put it in a table looking like this might look pretty similar to if you were to pull up your checking account online with your bank. You see money coming in, you see money going out. So our debits are going to be money coming in. So here we collected, say, accounts receivable. We collected $10,000. We sold something for $5,000 and $4,000. And then we've got expenses or credits on the other side, and those are highlighted in kind of a reddish maroonish, right? So if we're in the red, we're losing money. If we're in the black, we're gaining money. So I'm paying rent, we're paying salary, other bills, and taxes. So your credits are your expenses, money going out. Your debits are your revenues, your money coming in, and then on that far right hand side, just like your checking account, you can see what your current balance is, money available to your organization. Now you'd think money in, money out, it's pretty simple. If I get money, I get money. If I spend money, I spend money. And looking at my debits and my credits, my revenues and my expenses, you can pretty quickly determine how much money you have on hand and available for you and the financial health of your organization. But there are different accounting types, and there are many different accounting types, but we're gonna highlight just a couple big ones here. To start with, we have two very broad accounting types, both financial and managerial. Your financial accounting, probably the one you're going to be most familiar with. This is going to external uh, stakeholders, stockholders. This is tax preparation time. This is your financial accounting. On your managerial accounting side, this is just internal reporting. Maybe your boss wants a report. Maybe the county manager wants a report, and this is just for internal distribution and is not meant for, let's say, for example, the IRS to start picking through. So whether you are creating a financial accounting report or a managerial accounting report, these play into decision making a great deal. So a lot of budget decisions are based on accounting. We need to know what money is available to us, what we can spend. If I want to buy a new ambulance, but I only have $1,000 on hand, I that's a very important information for me. So do I need to go out and get a loan to buy that ambulance, or can I pay cash, right? So if I didn't know how much money was available to the organization, then I'm making kind of a shot in the dark decision. So budget decisions are heavily influenced by our accounting reports and our accountants. Sunk costs. We need to discuss sunk costs pretty quickly. In the decision-making process, we need to identify these sunk costs and then throw them aside. So a sunk cost is something that we have already paid for. The money is spent. It's done. Um, and if we take that into account, it might sway our decision. So let's say uh, I am going forward with a program, a new FTO program, and I've sunk $10,000 into it, employee costs, benefits. I've sunk $10,000 into it, and it's just not working out. It's not doing what I thought it would. It's actually working worse than our previous FTO program. So going forward, should I continue that new FTO program? Well, no, I shouldn't because it's not working. But sometimes, oftentimes, we take these sunk costs and say, well, I've already spent $10,000 on it, so I should just stick with it, right? So recognize that $10,000 it's already spent. It's not coming back. If I stop that program, it's not coming back. If I continue that program, it's not coming back. That new program isn't working, so I'm not going to recoup any of those costs. So just know that $10,000 that I've sunk into it already, that's a sunk cost. It's gone. If you want to think about sunk costs in a non-financial manner, a lot of behavioral economists use relationships to illustrate sunk costs. So your relationship isn't working with your significant other. It's just not going well. But you've put 5 years into it, so you should just try to, uh, bulldoze through it, right? Those 5 years, that's a sunk cost. It's gone. It's already happened. Nothing's coming back. So you need to make the decision in the present moment with the information that you have. So you can identify sunk costs wherever they may lie, and just know that we have to ignore those sunk costs and in our decision-making process. Additionally, when we're decision making and using our accountant's information, especially with budgets, we have to take inflation into account. So I'm going to throw a couple formulas at you. We can calculate inflation. So I have $1 right here in my hand right now, and that dollar, I can go ahead and calculate the future value of that dollar. So if I were to buy an ambulance right now for $100,000, what is that $100,000 worth in 5 years? So if I were to instead invest that $100,000 instead of buying an ambulance, what is the value of that money in 5 years? Or what is the past value of money? So I have a dollar right now, and what was that dollar worth in 1920? Right? So we're usually interested in the future value of money. So future value equals the present value, the PV, present value, and it's 1 plus R, which is the inflation rate. So if my inflation rate is 3%, R would be 0.03, so 1 plus 0.03, so 1.03, and that's raised to T, and that's how many years you want to go forward. So if I'm going forward 5 years, that T is going to be 5. If I'm going forward 10 years, that T is going to be 10. Same with past value of money, is just uh, switching around the present value and the future values, right? So I can find a past value by taking the future value and dividing it by that interest rate. But most commonly, we are interested in the future value of money because I can do two things with this pile of money. I can do two things with my dollar right now. I can go out and buy a candy bar, or I can go and invest it, and which one is going to yield the best return on investment. And that's usually where we're calculating the future value of money, is what do I do with this money? Is it better to invest, or is it better to buy the ambulance, or is it better to buy maybe a new station, right? So to give you an example, we want to know the future value of $2,000 that I have in pocket right here, right now. So remember, our future value of money equals the present value, that 2,000, times 1 plus the interest rate, or the inflation rate here in this example, raised to the time period that I'm going forward. So if we go ahead 3 years, let's say, and we are estimating that there will be a 3% inflation rate over those 3 years, I've got $2,000 right here, right now in 2019. In 2020, or excuse me, 2022, I've got that $2,000 times 1 plus 0.03, since it's a 3% inflation rate. I'm going to head 3 years, so it's raised to the power of 3. So in 2022, I'm going to have $2,185, right? Or it's going to be worth $2,185. So this is an inflation rate, not necessarily an interest rate. You can play it kind of both ways, but if we're looking at inflation rates, what's it going to be? What's the buying power going to be in 2022 versus today here in 2019? So something I want to point out, real easy, quick calculator if you don't want to do that manual formula yourself. The Bureau of Labor Statistics, BLS.gov, has an inflation calculator there for you. You can just input your numbers and it pops something up really quickly. This is really important because we want to compare across time periods in what we're going to call constant dollars. So a dollar I picked 1999, 20 years ago, is not the same, doesn't have the same buying power, is not the same as a dollar here in 2019. So if we're comparing our financial health in our organization across these time periods, it becomes very important to put our dollars into constant dollars, so we're comparing apples to apples and not apples to kiwis. If we're doing it year to year, if I'm comparing this year back to last year, it doesn't really matter that much. But again, if I'm going back 20 years and I want to know my organization's financial health versus what we had in 1999, 20 years ago, we need to put our monies into constant dollars. So if I made $2,000 in profit in 1999, that would be the same as making $3,100 in profit in 2019. So $2,000 in 1999 has the same buying power as $3,123 in 2019. That's the inflation rate, taking account inflation rate, and they're doing that formula and that calculation for you without you having to do it manually. So if I'm looking at my organization's profits, and we made $2,000 in profit in 1999, and in 2019 we made $2,500 in profit, it looks like we're making more money than we did in 1999, but if we put it in constant dollars, we've actually gotten worse. So if you're comparing money and profits or revenues, expenses, any money across time periods, we need to put these in constant dollars so we are comparing apples to apples. So there are different forms of accounting. Again, you might think this is pretty simple. Money comes in, money goes out. I write it down. Our bank keeps track of it, and there we go. But a couple different types I want you to be aware of. Again, we're not accountants. I'm not an accountant. I just want us to have an awareness of what's going on behind the scenes, whether our accountants are in-house or if we contract to an accounting firm. First is cash accounting. And that's a pretty typical personal budget. So the budgets that we probably all keep. I know I do. Our revenues are recorded when they're received. So my personal budget, when I get my paycheck every month, that's when it goes into my budget. That's when it's recorded. And then my expenses are recorded when I pay them. So I might owe, let's say my car, right? I owe a few $1,000s on it. Actually, I just looked it up. I think I owe about $5,000 on it still. And so, but I'm recording my expenses when I pay them. So each month I pay my monthly bill to Volkswagen. They take all my money, and that money is recorded each month when I pay it, even though I owe a larger amount than I am paying each month. So cash accounting, revenues are recorded and inputted when we receive them. Expenses are recorded when we pay them. Cash accounting is great for personal budgets and very small businesses because it's pretty easy to keep track of, and we're not making huge purchases that we're accountable for. If we buy something, we probably buy it in the moment, right? I go grocery shopping and there's my food. For businesses, however, typically use accrual accounting, and this gives us a more accurate picture, a better picture of our financial health and our financial well-being. So our revenues are inputted, recorded when they're obligated. So I've got money coming in as an organization. When I send out a bill, let's say to a patient, it's being recorded when the bill is sent out, right? So we know they owe us money, and I know I'll have money coming in, right? So when I send the bill out, that's when I'm recording the revenue. I'm not recording it when the money comes in, right? So our accountant, using this accrual accounting, knows that we are owed $500 and we should be getting $500 in the near future. Our expenses, instead of being recorded when we spend the money, we record them when they are what we'll call encumbered. So I buy an ambulance for $100,000. I'm going to plug it in, and our accountant is going to plug it in when we place the order, not necessarily when we pay the money, not when we incur the expense, but when we make the obligation. So our accountant knows that we've got some money owed to us with the revenue on the revenue side, and our accountant knows that we owe someone money in the future, in the near future. We have some obligations on the expense side. So that gives us a better overall picture of our financial health, because it takes into account that we know what our obligations are and we know what is owed to us. If your cash versus the accrual accounting sounds a little strange, maybe a little confusing, there's also a Khan Academy video up for you where an actual accountant goes through some examples to show you the differences between cash and accrual accounting, and how accrual accounting can give you a better picture, and why it's better for businesses and our organizations. One last thing I'd like us to be aware of when talking accounting and money in, money out. Some of your money in might come from donors. Might call these endowments. So someone donates money. These donors might put restrictions on this money. So someone donates $10,000, but that donor says it must go towards X, Y, or Z. Right. So a donor donates $100,000 and says this is for a new ambulance. Well, guess what? Now you have to buy an ambulance with that money. So there are donor restrictions on these endowments. Sometimes there aren't restrictions. So it just depends on the donor, And on the legal side, where this money is to be spent, sometimes a donor might say, "Here's $100,000. Spend it as you wish to aid the organization." And sometimes they say you must. This is for a new ambulance, and you legally have to use the money on an ambulance. Um, and then sometimes these endowments, they say, here's $1 million, and you can only use the interest accrued, right? So um, here at WCU, the EMC program has an endowment. There's a wonderful family that will be endowing $1 million to us, and we can only use the interest earned on that endowment, right? So by doing that, that keeps the endowment going into the future. So each year, we can only use and spend whatever the interest has accrued over that past year. So if you get donors, get donations, these endowments, sometimes there are restrictions on them, and sometimes we can't use. So like that $1 million, I can't go out and just spend that $1 million. I can only spend and use whatever the interest has accrued on it. So just because you get a donation doesn't mean you can use that complete donation, and doesn't mean that you can use that donation for whatever you'd like. As always, please let us know if you have any questions, comments, concerns, or cuss words. I know that was a very quick overview of accounting. There's an extra video there for you and some extra materials there for you in Blackboard. But we just want to have an awareness of accounting methods and principles, so that when our accountant gets back to us, either monthly or quarterly or yearly, we kind of know what we're looking at. So please let us know if you have any questions.